Hi, everyone. Eric Greschner with Regatta Research and Money Management here. The beginning of the new year is a perfect time to discuss the numerous planning opportunities for your nest egg. For example, we can look at the progress that you've made towards your goals and also consider any new goals that you've set for yourself. Evaluate your insurance coverages to make sure that your risks are minimized and your assets are properly protected. Revisit your assets and your debt and evaluate whether your risk tolerance continues to be appropriate. Our Regatta team has put together this video and a checklist for you. 43 financial tips and planning opportunities to start 2024 off on the right foot. Let's jump right in. Let's start at 35,000 feet with tip number one. Assess the progress you've made towards your goals from last year. Once that's done, let's then jump forward to look for opportunities for both a tax investment and, if applicable, debt reduction strategies. There are a large number of opportunities available for you. In fact, we've put together 43 of them, and the calendar year is a great excuse to set these in motion now. Number two, have you identified your new goals for 2024 and beyond? If so, these need to be incorporated in your overall plan. Standard operating procedure is to assign a priority, time horizon, and projected cost for each item. Of course, your Regatta team is here to help you with this item along the entire way, along with the 42 other financial planning tips for 2024 that we've put together for you. Number three, are there any life events that are likely to occur for yourself or your immediate family member this year? Think of things like moves, marriages, divorces, birth, going off to college or graduate school, changing jobs, retirement, illness, or, unfortunately, reality is death. If so, there can be significant opportunities to take advantage from a financial to a tax to legal. Now, we're going to do a deeper dive into each one of these tips in this video for you. Let's jump ahead to tip number four. You need to confirm whether you or any family members will reach a milestone age this year. For example, turning age 18 and becoming the age of majority, 59 and a half, perhaps being old enough where you're required to now take required minimum distributions. If so, a number of changes need to be made in your overall financial plan, cash flow, and budgeting management for each of these different milestones. Contact us for further guidance as we could help you with any of these milestones that you may have reached or be close to reaching. We could also send you the important age milestones checklist and flowchart for 2024 that we put together for you if you'd like. Just reach out to us. You can email me directly at eric@regattaresearch.com or just reach out to our office. Number five, are you concerned about any additional variables or any circumstances that could impact your plans for this year? These can be factored into your financial and investment plan as well. Just let us know what they are, and as usual, we'll make sure that it is taken care of for you. Now, what about cash flow planning opportunities? Let's start off with number six here. Do you expect your household income and or expenses to change materially this year? If so, your budget, your cash flow, assessments and statements and projections may likewise need to be updated to determine with specificity as to whether your income and expenses will be going down and by how much, and what are the opportunities or changes in course that you may want to implement. The recent highly elevated levels of inflation may also need to be reflected across your financial plan, and particularly with your cash flow and spending statements. Now, let's move on to the next one. Tip number seven. If your cash flow plan needs to be reevaluated, start at ground zero, right out of the blocks. Start with evaluating your actual income and expenses and adjust your spending plan as necessary. We always, as standard operating procedure, recommend a written budget to make sure that you have the most accurate assessment possible and there's no surprises in your planning, or at least they're minimized as much as possible. Tip number 8 for 2024, review your employee benefits at your employer to ensure you're taking advantage of everything that your employer offers. For example, consider maxing out any annual contributions, particularly if there's matching, to your retirement accounts, your 401k, your 403b, health savings accounts, flexible spending accounts, also called FSAs, health savings accounts, and or dependent care flexible spending accounts. Many of the limits for these different programs have gone up this year, so it's important to make sure that your contributions are increased to reflect the larger contribution amounts. Do not miss out on these opportunities to save on taxes and increase your savings, because that window opens and closes every year. And if you miss it, you can't go back and contribute. So that opportunity is gone. Number 9, are you able to contribute to an IRA? If so, and if you're not already doing so already, strongly consider funding a Roth IRA or making deductible contributions to a traditional IRA, or making after tax contributions to a traditional IRA, depending on your eligibility. If you're married and your spouse does not have earned income, there are still potentially available planning opportunities with the spousal IRA options. These tax benefits from qualified accounts are excellent vehicles for growing your wealth over the long term. Again, the window for these contributions open and closes every year. Make sure that you don't miss it. Number 10, confirm that you're adequately saving towards your goals in 2024. The beginning of the year is a great opportunity to review your target savings and funding rates. If you fully fund some goals early in the year, continue saving towards other goals in the latter part of the year. 11, do you have funds left in your FSA from last year? A flexible spending account, also again known as an FSA, provides the account holder with very specific tax advantage and also plan limitations. The account allows you to contribute a portion of your regular earnings before tax. Employers can also contribute to their employees' FSAs, and distributions from the accounts must be used to reimburse the employee for what are called qualified expenses that are typically related to medical and dental service. If you do have an FSA, consider spending such funds before the expiration of any grace period. Financial planning tip number 12. Are you subject to taking RMDs, including those from inherited IRAs? If so, consider the following tips. If you're charitably inclined and age 70 and a half or older, you could do what's called a QCD to satisfy your RMD for all or part. Also known as a qualified charitable distribution, it's a distribution from your IRA to a qualified charity. There's a few limitations on it. You must be age 70 and a half or older to make a QCD. A qualified charitable deduction is not taxed, and it gets even better. It's not included in your taxable income. Keep in mind of what we call the first dollars out rule, and also time the satisfaction of your required minimum distributions to support your goals. And be sure to review your withholdings as well. Item 13, do you make annual gifts? If so, make a plan to fund them strategically and make sure that you track the use of your annual exclusion or non-charitable gifts. In the event that you're audited for the IRS, you want to make sure you have all your records ready to go so there's no issues at all. Now, let's talk about asset and debt planning opportunities, a number of those as well. Do you need to adjust or replenish your emergency savings fund? The start of the new year is a great opportunity to revisit those as well. An ESA or emergency savings account is a safeguard against unexpected expenses, emergency spending situations. Let me give you an example. You lose your job or you experience a major medical emergency. An ESA can help get you through this period without taking on debt. An ASA can also allow you to seek medical care if needed, keep your home if you lose your income or your job. It could reduce stress due to emergency home or car repairs. And the amount you need to have an emergency situation depends on your situation, the number of dependents, the liabilities you have, the stability of your job, etc. Think about the most common kind of unexpected expenses that you've had in your past and how much they cost. This can be used to help you set a goal for how much you want to set aside. A general rule of thumb is to start the conversation, not end it, just start it, is 3 to 6 months of living expenses, but that could be more or less. But again, that is a general rule of thumb. Financial tip 15 for 2024. Are you planning to buy or sell a business, personal or real property this year? If this is done in advance from a planning perspective, you could potentially generate a lot of planning opportunities ranging from tax loss harvesting strategies, using insurance as a tax planning tool for buying and selling a business, exiting, succession, etc. If you're selling real property, real estate, a potential 1031 exchange could lead to a extended, potentially tax deferred situation on any capital gains that were owed. A ton of possibilities, but the key to this is to know what they are, identify them as quickly as possible. Number two, obtain advice or at least do some research on it yourself in advance of any type of transaction. And thirdly, consult with a professional to make sure everything is lined up straight and you're not doing it to the fact when your opportunities may be significantly circumscribed. Financial tip number 16. Do you need to review your investment risk tolerance? Risk tolerances can change for a number of reasons, including just migrating over time due to age or becoming older. All things being equal, many people tend to be a little bit more conservative. Your health situation may have evolved as well. If you were once sick and were very concerned about taking any large losses, your income was potentially significantly reduced or at risk of doing so, oftentimes people, naturally so, want to become more conservative. And the converse may also be true for people who were once healthy and find that their health starting to deteriorate. Retirement, once you're retired, you're no longer earning any income. That often causes people to prudently become more conservative as well. Changes in income or family circumstances, it is prudent to revisit your risk tolerance just periodically as standard operating procedure. In the end, figuring out how much risk you could really handle is a combination of both art, a qualitative assessment, as well as a scientific quantitative assessment. And these guidelines are based on your age or time frame to start with, but ultimately it comes down to how much you can afford to lose, both emotionally and financially. And once that is determined with specificity, a plan can be put together and revised that balances your long-term need for growth with your understandably near-term need to sleep at night. Now let's jump to item number 17, Review the performance of your investment accounts. Pretty straightforward. Prudent to do this at least annually. Typically, they're done over a 1, 3, 5, and 10-year period, with the most significance being assigned to the longest time periods, with the goal of eliminating noise from true underlying signals. Financial tip number 18. Do you need to rebalance your investment portfolio or otherwise adjust your asset allocation? Now, our firm typically does this for our clients. Those of you who work with us know this, but the general rule of thumb when doing this is to consider not only your overall needs and risk tolerance, but also any tax consequences and the impact on the portfolio that may be associated with periodic portfolio rebalancing and non-qualified accounts. And the accounts can be traded strategically to improve the post-tax returns. If you made any trades last year that were meant to be short-term, example, tax loss harvesting, or to avoid or postponing capital gain distributions, revisit the strategy on an ongoing basis, and these should be repositioned as necessary to maximize the post-tax returns in the portfolio. We, of course, do this on our clients on an ongoing basis, but nevertheless wanted to share that as one of the key tips. Tip number 19. Do you need to review your asset location across the accounts in your portfolio from a tax perspective? This is what we call asset location, essentially a tax minimization strategy that takes advantage of different types of investments getting different tax treatments in different types of accounts. And using this strategy, an investor, typically in conjunction with their financial advisors, determine which securities should be held in tax deferred accounts and which in taxable accounts to maximize post-tax returns. All things being equal, we like to hold tax-efficient investments in taxable accounts and tax-inefficient investments in tax-preferred accounts. Your Roth IRAs, your traditional IRAs, etc. Let's jump to asset and debt planning opportunities for 2024. If you have a mortgage, should you explore refinancing? Rates spiked to 8% last year. Very, very high based on the last couple of decades. But thankfully for many homeowners, they're in the process of finally coming down. You may want to consider refinancing at a lower rate if rates continue to decline by a significant amount to more than adequately offset the closing costs, etc. A big opportunity, own the property, but lease the rate. Financial planning opportunity number 21. Like many Americans, are there debts that you would like to eliminate this year? If so, strategically target debts with the least favorable terms. Example, pay those with the highest interest rates first, and that way you're, of course, paying significantly less in interest carrying costs. Number 22, are you a cosigner or guarantor on any loans or agreements? For example, some parents or even grandparents will act as cosigners or guarantees on their children's student loans, just for example, or it could be to help someone buy a house or maybe a business excel. If so, check in with the other interested parties to confirm the terms, payment history, current status. What if the person that you're signing for is not making the payments? Is this going to potentially affect your cash flow and even potentially credit rating if you didn't know about it? Make sure this doesn't limit your investment options or, unknown to you, hurt your credit score. Financial tip number 23 for 2024. Will you potentially need to borrow funds this year? If so, we recommend visiting your cash flow statement early to review. See what you could do to increase your income and decrease any liabilities before applying for the loan. Typically, when they do their underwriting, they're looking at your debt to income ratios. You want that to look as attractive as possible before you can maybe arrange things around or pay some debts off to make the credit score as high as possible to get you the lowest loan with the greatest number of people competing against it. Number 24, do you need to review your credit report or score? If you do anticipate doing such, pull your credit report now. See if there are any issues you may not have been aware of before applying for that loan. We don't want any mistakes. We don't want any surprises. We want the time to correct them, particularly if you have a contract to buy that particular item within a certain period of time. You don't want to start running into any funding issues, and the result is that those rates or terms are unfavorable to you when that could have been avoided with just a little bit of advance planning. Item number 25. Do you need to freeze your credit? If you do not plan on borrowing money anytime soon, the new year is an opportunity to freeze your credit. And this could be used to help prevent any identity theft where someone may take out loans in your name that you don't know about, run them up, not make the payments, and then hurt your credit when it comes time for you to borrow it. Let's jump ahead now to insurance planning opportunities. We got a bunch of great things to share with you in this segment as well. Do you expect any changes with regard to your health or medical treatments in 2024? If so, consider reviewing your health insurance coverage and alternate options. This is the time to typically renew your insurance coverage. You want to make sure that your plan is reflecting to your best ability what your potential needs may be in 2024. This is becoming more and more critical as the inflation rate of medical care continues to increase at a high and ultimately unsustainable rate. But nevertheless, this is one of the issues that we see people getting in trouble with from a cash flow and in some cases debt perspective. So make sure that you spend a little bit of time reviewing your insurance coverage options, not just health insurance, but life insurance as well. And that's a beautiful segue to tip number 27. Review your life insurance coverage. Has the number of your dependents changed? Have you have younger new children? The birth that you need to get coverage applied to them, or perhaps you have older children who are graduating from college and can no longer be covered and should be dropped and have their own insurance coverage. Make sure you're not paying for them and not receiving any of the benefits. The amount, the type, and the timing of the coverage may need to be changed in 2024 if your circumstances have changed as well. Great time to explore these now. Tip number 28. Do you need new or increased disability and insurance coverage? A annual review is a great opportunity to take a look at this. Don't overlook disability insurance. Many people make the unfortunate conclusion that it's not going to happen to them. They won't need it. That's unfortunately not the case. According to the Centers for Disease Control and Prevention, up to 27% of adults in the United States have some type of disability. This translates to approximately 61 million Americans. Do not think that this can't happen to you. An unanticipated, improperly funded disability can torpedo a retirement plan, and we don't want that to happen to you. Financial tip 29, 2024. Is it time to explore or review existing long-term care insurance? The percentage of elderly people who need long-term care varies depending on how it is defined, but a common estimate is that 70% of Americans age 65 and older will require some type of long-term care at least at some point. What does long-term care entail? Think of nursing home care, assisted living, home health care, and personal care. The average length of stay in long-term care is 3.2 years, and these costs are often not covered by Medicaid or Medicare. That's a big mistaken assumption that we often see people making. They assume that Medicaid or Medicare will cover. It's often not. If not properly planned for, the cost of long-term care can literally destroy nest eggs. Long-term care can be expensive and it can be complicated. It also has rising premiums and reduced coverage on an ongoing basis. But regardless, it's still important to at least have the conversation. And there are alternative funding options available, but these need to be discussed and modeled in advance. If you need help on this item or any of the 43 tips listed in this webinar, your Regatta team put together for you, please reach out to us. The Regatta team is always here to help. So just pick the phone up, drop us an email or whatnot, and we're here to help point you in the right direction and get this solved for you. 30, have you made any improvements to your property or acquired new valuables, jewelry, paintings, heirloom antiques, etc.? If so, consider reviewing your property insurance, your homeowners, if you rent, your renters, and increasing the coverage and or adding riders as appropriate to make sure you're fully protected, particularly if your house has experienced significant increase in property values over the course of time. You want to make sure that you're protected in the event of some type of damage or destruction from a hurricane or whatnot. What about tax planning opportunities? Number 31. Do you need to collect tax forms and organize other documents in preparation for filing income tax returns for 2023? If so, for most of us it is, use last year's filings as your base, of course, and we recommend a tax organizer to start collecting all the information necessary for filing Form 1040, any state tax returns. When it comes down to it, K1s will be coming out, etc. And when the time comes to file taxes, you are ready to go and reduce the chances of getting hit with any late filing penalties. Financial tip number 32. Did you make taxable gifts or did you want to split gifts for last year? If so, similarly, collect documentation necessary for filing Form 709. Opportunity number 33. Would Roth IRA conversions potentially be beneficial for you this year? There are a number of reasons to convert to a Roth IRA. Converting from a traditional to a Roth IRA, just for example, allows your savings to grow undiminished by required minimum distributions, and this can leave more for your heirs, who could generally withdraw the money tax-free as long as they follow the IRS's distribution rules. Pretty straightforward, but a lot of planning opportunities with these Roth conversions, particularly if you have a longer runway and you feel that tax rates will be going up over the course of time. Item 34. Did you fail to make an IRA contribution for the prior tax year, but would like to do so? If so, you have until tax day, excluding extensions this year, to make a contribution for last year. So take a look at this. That window opens and closes every year, and you could still put it away for last year. If that is the case, don't miss out on that opportunity. That window, again, opens and closes, and we don't want you to miss out on it. 35. Do you own investments in taxable accounts that are likely to make capital gains or income distributions, such as certain mutual funds or ETFs, If so, consider what your cost basis might be and whether it might be advantageous to sell in advance of any such distribution so you're not the one receiving them, but the person that you sold the shares to is. Item number 36. Review your unrealized gains and losses in your taxable accounts and create a harvesting strategy if you want to sell some of those shares. A tax loss harvesting strategy is a very simple strategy to lower federal taxes by deliberately incurring capital losses to offset taxes owed on capital gains, or even in some cases, taxes owed on personal income. Remember that tax loss harvesting strategies only defers tax payments. It does not cancel them. Regardless, the deferral of tax payments can result just simply due to the time value of that money of resulting in a superior post-tax outcome versus not using a tax loss harvesting strategy, something that we recommend. Let's turn now to legal planning strategies. Do you need to review your estate plan? Even if you're not impacted by federal estate taxes because the size of your estate is below the current amounts, there are still plenty of sound reasons to review and update your estate plan on a periodic basis. Let me just give you some examples. Um, Asset disposition. Your last will, your testament is the most important vehicle for documenting your intentions. And even if you've got a revocable trust, you may need to update this as well to reflect your changing situation. Another trigger, another catalyst may be the management of your estate. A key aspect of any estate plan is appointing an executor. An executor is the person, or in some cases, the institution, who will handle the affairs of your estate once you pass. Do you want to change the executor for any number of good reasons? If so, great opportunity to revisit this. Do you have minor children? Do you want to change who the guardian has been? There may also be new and different trust strategies and even new tax saving strategies you may want to take advantage of. This is a great opportunity to reach out to your attorney, your tax preparer, and your financial advisor to make sure that everything is squared away and you're optimized to take advantage of every opportunity available to you. 38, review the titling and ownership of your assets. If if your familial situation has changed, the beginning of the year is likewise a great opportunity to revisit the ownership, the beneficiaries, who's primary, who's contingent, and in what percentages to make sure they reflect your wishes and the current family dynamic. Item 39. Are you or will you be serving as a fiduciary in any capacity? Are you on some type of charitable board or corporate board? If so, consider reviewing your duties and your performance to ensure that you're upholding yourself to applicable standards. You don't want to have complaints or lawsuits filed against you by proceeding in good faith and fair dealing, but making an error and not meeting all the standards. Just a lawsuit mitigation strategy. If you are a executor, if you're a trustee of a irrevocable trust, consider whether a distribution and election under what we call the 65-day rule would be prudent as well. Tip number 40, are there any new laws going into effect that might impact your financial plan that you could modify it to incorporate this and have a better outcome? There's typically always new tax laws that are coming out that will provide new opportunities out there, or greater new contribution limits, new vehicles. If so, and they are out there, consider how your saving strategies, your income tax situation, your estate plan might have been affected and what steps might be necessary to, again, maximize those opportunities in 2024 and, for that matter, for every year going forward. 41. Are you subject to any new contracts, agreements, or did any such arrangements expire? Are these something like non-competes, or there's some type of independent contract or gig economy? Did they expire? Will they expire? What modification do you need to offset them? Or are they offering new opportunities for deploying cash, income, or a further ability to monetize your overall nest egg? 42, do you own a business? And if so, are there any changes on the horizon this year that, with advanced planning, can result in significant tax savings? This is typically the case. If you have, for example, a company with no retirement plan, we make recommendations to set those in motion sooner rather than later. They could take some time to decide the type of plan that is optimal for your business, and they have different cutoffs for different types of plans, and you don't want to have the optimal plan for your company have to be shelved for one that's perhaps second or third on the list because you miss the cutoff date. Again, advanced planning solves many of these problems, and January of 2024, the new year, is a great catalyst to start this discussion early. Item number 43, last but certainly not least, are there any state-specific issues that you may want to consider, such as new state or inheritance tax laws that you need to be aware of? Is this going to trigger a conversation with your tax preparer or your attorney to take advantages, again, of new opportunities that Congress or your state legislature have provided? But again, do it early is the mantra that we continue to repeat to allow you to take advantage of these over the full calendar year 2024, not doing it in April, or if you file extensions, September, October, or whatnot. Now, let's go ahead and start wrapping things up. This video covers just the highlights, 43 tips, but it's just the highlights. And if you don't already have a copy of the full 43 financial tips, we send these all out to our clients. But if you would like one to share with a friend or family member, absolutely just email me at eric@regattaresearch.com, eric@regattaresearch.com, and I will gladly send this out for free, of course, to anyone who would ask. It's a wonderful planning opportunity, and make sure that everything is done comprehensively and systematically. If you have any questions about the 43 tips, please feel free to reach out to me or any one of our team members, or call us at 1-800-932-0017. And if you enjoyed this video and would like to learn more about investing, financial planning, asset allocation, and haven't done so already, please reach out and follow us on social media, Facebook, Twitter, LinkedIn, and our YouTube channel as well. Until next time, and on behalf of our entire Regatta team, thank you very much for joining me. Bye-bye. Thank you.